Welcome to Coffee Talk. The government in the Budget 2024 announcement on 13 October 2023 proposed new taxes on capital gains and foreign source income to take effect from early 2024. These taxes would have significantly impacted unit trusts and private retirement schemes, as well as broader industrial ecosystem. However, on 16 January 2024, the government announced a temporary tax exemption for unit trusts. FIMM is grateful to the Ministry of Finance, Bank Negara, the Securities Commission, its members and tax consultants for their collaborative efforts which helped to achieve this positive outcome. Recently, in October, the government, through its Budget 2025 announcement, declared that it would introduce a 2% tax on dividend income exceeding 100,000 ringgit. Separately, following Inland Revenue Board's announcement in 2023 on the implementation of E-Invoicing in 2024, it had on 6 April 2024 issued updated E-Invoicing guidelines. The government has stated that these measures, including new taxes on E-Invoicing, are aimed at supporting national growth. But what do they really mean for investors? To help clarify things for our viewers, we have here with us today Mr. Fariz Faruk joining us for the conversation.
Hi, thank you.
Hi, Fariz. Mr. Fariz brings over 18 years of expertise in business tax compliance, advisory, and tax dispute resolution with Deloitte. He is a partner and executive director leading Deloitte Malaysia's tax audit and investigation services, helping clients manage tax disputes with the Inland Revenue Board. His experience spans a broad range of clients from private companies to multinational corporations and government-linked companies across diverse industries. Mr. Fariz is also a member of the Chartered Tax Institute of Malaysia. Mr. Fariz, welcome to the show.
Thank you. Thank you.
Thank you. The Gazette orders for the income tax exemptions of unit trusts for foreign source were released on 20 September 2024. The important points gleaned from these gazettes are that while there is a temporary tax exemption to these, they do have a time limit. Mm-hmm. Specifically, the duration of exemption of CGT for unit trust is effective from 1st January 2024 to 31st December 2028, and FSI tax until 31st December 2026. Mr. Fariz, before diving into specifics, could you help our viewers understand what these exemptions mean and the potential impact on investors if the taxes were to be implemented after the exemption period ends?
What is capital gains tax and foreign source income tax? First, capital gains tax. Capital gains tax in a layman term is a tax imposed on gains or profit from disposal of capital assets. And if we look into the scope of capital gains tax in Malaysia, first, it applies to disposal of non-listed shares of a Malaysian incorporated company. Second, it applies to disposal of foreign company shares, where the foreign company mainly derive its value from real property in Malaysia. And third, it applies to movable or immovable property situated outside of Malaysia. So the first and second category are regarded as a Malaysian source capital gains tax. Whereas the third category for disposal of any movable or immovable property situated outside of Malaysia, that will be regarded as a foreign source capital gains tax. And who will be impacted by the capital gains tax? Who are the chargeable person? There are four main categories. First is company, second limited liability partnership, the third is a cooperative society, and fourth is trust bodies. So trust bodies includes unit trust funds, and individuals are not part of these four categories that are subject to or chargeable person for capital gains tax. And the recently released capital gains tax exemption, right, which is applicable to unit trust funds, right, provides exemption to Malaysian resident unit trust fund, right, except for REITs or real estate investment trust and property trust fund from capital gains tax. So there's exemption available on capital gains tax, right? But however, the exemption is only applicable from the period of 1st January 2024 until 31st December 2028. So during this period, any disposal made by a unit trust fund or disposal of unlisted shares made by unit trust fund, unlisted shares in Malaysia, as well as shares in a foreign company which mainly derive its value from property in Malaysia, real property in Malaysia. So gains from this disposal would not be subject to, or would be exempted from capital gains tax on the unit trust funds, right? The resident unit trust fund. And just now also you mentioned about another concept of foreign source income, right? So what is foreign source income? In a layman term, basically income rises from sources outside of Malaysia, right? And this one is the impact will be impacted to all taxpayers, right? Except for certain exempted categories, right? And there are various exemptions available, right? And unit trust fund, and the recent exemption accorded by the government is that unit trust fund is being exempted on the foreign source income remitted into Malaysia, right? So meaning that during this period, 1st January 2024 until 31st December 2026, right, there will be exemption on foreign source income, which include capital gains derived outside of Malaysia, right? And the unit trust funds would be exempted on the foreign source income, right? So what will be the potential impact to the investments in unit trust funds? I don't think these taxes would have significant impact to the investors, but more towards the fund, the unit trust fund itself.
Well, that's certainly good news for investors. But if these exemptions were not in place, what would have been the impact on investors?
If there is no, if these exemptions are not in place, if you look at capital gains tax, right? So for disposal of unlisted shares in Malaysian companies by unit trust funds, right, would be subject to capital gains tax, right? And therefore, the tax rate applicable basically is either 2% on the gross proceeds, right, or 10% on the net chargeable gain in respect of the gain on disposal of shares where the shares were acquired before 1st January 2024. Right? And secondly is that it will for the shares that are acquired after 1st January 2024 and disposed by the unit trust funds, right? And these are unlisted shares in Malaysian companies, right? It will be subject to a 10% of the net chargeable gain. For foreign source income, right? If there's no exemption applicable to the unit trust fund, the unit trust will be subject to income tax at the prevailing income tax rate, right, on the foreign source income remitted into Malaysia. Right? The prevailing tax rate is at 24% at the moment. And whether this would have implication on investors, right? I wouldn't say it would carry a very significant implication. Right? Firstly, we look at the scope of Malaysian capital gains tax, right? It applies to disposal of unlisted shares in companies in Malaysia, incorporated in Malaysia, right? And if we look into the portfolios of the unit trust funds, I wouldn't think unit trust funds would have significant investments in unlisted shares as much as compared to listed shares, right? Therefore, the impact could be minimal to certain unit trust funds. Right? But if you look from another angle of foreign source income tax, right? So this would naturally affect to a certain extent the investment returns of the investor that invest in unit trust funds that mainly invest in foreign investments, right? Whether how significant the impact will be to the rate of return, right? It would depend on a lot of factors as well, right? And taxes are not just the main factors.
Right. In your professional opinion, do you think unit trusts will remain as appealing to investors should the taxes be implemented?
My personal point of view is, firstly, it will affect certain perceptions. Right? It's just more towards perception, whereby with the new taxes being imposed on the unit trust fund, how that will affect the rate of return on the investments made by the investors. Right? To a certain extent, there could be some implications, right? And as I've mentioned earlier, probably how severe the implications, it is very subjective. Right? And I do think that investments made by investors in unit trust funds are not solely or highly dependable on what is the tax profile of the unit trust fund itself. Right? So at the end of the day, whether it will remain appealing or not to the investors, it will still goes back to how attractive the rate of returns from this investment made by the investors in the unit trust funds. So my view here is that even if there's later on when the exemption expire, right, there could be certain perception. Right? It's just that how this perception are being managed by the industry players towards the investors.
If these taxes were implemented, at which stage of the investment process would investors feel the impact? For example, would it occur upon each redemption or only during annual income tax declarations?
Okay, because we are talking about the context of capital gains tax and foreign source income tax, right? And the implication is on the unit trust fund. Right? First of all, the unit trust funds are the entities that are being subject to these taxes, right? In terms of the redemption made by the investor, right? Whether it would be subject to income tax or not, whether if there's any gain, right? It depends on, it will remain the same irrespective of whether this capital gains tax and the foreign source income tax applicable to the Malaysian Unit Trust Fund. So gain on disposal of or gain on redemption of units, as far as I know, there shouldn't be any impact when it comes to capital gains tax, right? Whereby the units in unit trust funds are not regarded as shares in an unlisted companies in Malaysia, right? Yep. So therefore, there's no capital gains tax on any disposal, right? But the next question is whether any income tax on the redemption. I think that is a discussion for a different forum, right? Altogether. But my point of view here is that the position of capital gains tax and foreign source income tax, right? The investors would not feel any or would not incur any additional tax compliance requirements, right? It's at the unit trust fund level that will have implications.
How might the end of these exemptions influence investors' preference for short-term versus long-term investments within unit trust funds?
Well, at the end of the exemptions period for the capital gains tax and foreign source income tax on the unit trust fund, right? My personal view is that it shouldn't have any impact on the investors' preference, whether they would want to invest in unit trust fund, be it short-term or long-term, right? the key determinant for their for the investors to invest in unit trust funds are not solely on depending on tax only, right? There are other factors that they want to consider, right? And it all depends on the investment appetite of the investors.
How do you think these tax changes will position Malaysia's unit trust investments compared to the similar options in other countries, especially in regions where CGT or FSI might be lower or non-existent?
So whether these tax changes on capital gains tax and foreign source income tax will affect Malaysia's position in terms of the unit trust industry in Malaysia, my personal point of view, it should not carry significant impact, right? But definitely there could be some implications. Right? If we look at the investors' profile in the unit trust industry in Malaysia, right, are mainly Malaysian investors, right? The main bulk of it, of course. And for Malaysian investors, the decision making or the thought process, right? Even if they do not invest in a unit trust fund, then they need to find other form of investments, right? And other form of investment will still be they will be exposed to the relevant income tax applicable on those investments as well, right? And I think unit trust funds has always been used as a form of simplification of certain investments, rather than invest direct in a lot of securities, right? It is easier for certain profile of investors to invest through these unit trust funds, right? And whether they, with all these taxes in place, whether Malaysian investors, unit trust investors will shift their investment outside of Malaysia, right? Or specifically to unit trust funds outside of Malaysia, I think that should not be the determining factor for the Malaysian investors, right? The key factor will always be the rate of returns, right? So long as the unit trust funds in Malaysia maintain its, attractiveness in providing the certain level of rate of returns towards investors, I think the investors would still invest in Malaysian unit trust funds, right? But with all these taxes, it could the one thing that potentially would be affected is whether foreign investors that want to invest in unit trust fund in Malaysia, whether how they would perceive these new taxes, right? And it could hinder to a certain extent, right? But I don't think it will be the key determining factor, and therefore I don't think the introduction of capital gains tax and foreign source income tax will position Malaysian unit trust industry into a worse state position as compared to other countries. In other countries, there are also certain forms of capital gains tax and foreign source income, right? But of course, there are also few countries which do not have capital gains tax and foreign source income, right? But whether investors will shift their investments outside of Malaysia, I don't think these taxes are the determinant of those decisions.
In October, the Budget 2025 announcement included a 2% tax on dividend income above 100,000 ringgit. But it has been clarified that unit trusts are exempted from this tax. Given this exemption, do you think this will make unit trusts even more attractive to high net worth investors seeking to optimize their post-tax returns?
So the dividend, the proposed dividend income tax at 2%, right? So it is applicable to dividend income received by individuals that exceed 100,000 ringgit. Right? The implication, I think, is more towards high net worth individuals, right? But whether 2% on this dividend income would carry significant implications to the high net worth individuals, I don't think it is something very significant. The next question is whether with this imposition of 2% income tax, dividend income would make investment in unit trusts more attractive. Right? I don't see that is something really applicable. Right? So first of all, dividend income, whether investment decision whether to invest in shares or unit trust funds, there are other factors that leads towards these decisions. Right? For investment in unit trust fund, I think it becomes a little bit more attractive, whereby, let's say, if an individual invests in unlisted shares or in shares directly, right? So moving forward, dividend income will be subject to 2% income tax, right? Whereby if for unit trust funds, when they invest in unit trust funds make those investment in shares, right? The dividend income is exempted in the hands of the unit trust, right? And also the distribution made by the unit trust fund to the investors would also be exempted, right? And this is also specifically, the distribution made by unit trust fund is specifically excluded or exempted under the proposed dividend income tax of 2%. Right? To a certain extent, it makes it a little bit more attractive, right? But whether it will be a very strong, very strong factor for high net worth individuals to shift their investment out from shares to unit trust funds, I don't think that would be a right statement to make.
We understand that the upcoming implementation of e-invoicing will mainly be on the administrative side of things within unit trust management companies and distributors. Will this change the experience for investors in any way? For example, companies needing investors to provide updated details as required for the e-invoicing portal.
The implementation of e-invoicing, right? Like what you have correctly pointed out, it affects the unit trust management companies. Right? The question is whether it will change or will carry a lot of affects the investment, the investors' experience in investment in unit trust fund. I wouldn't. It would depend on how smooth or how seamless the unit trust management company would implement the e-invoice. And I do think every unit trust management company will try to adopt and implement e-invoice as seamless as possible. And the investors may not have, I would say, a lot of change, or they may not even feel that there's a difference, right? For certain instances, probably the statements, the formatting of the statements could change a bit. There could be a additional QR code here and there on the documents being issued or the invoice being issued by the unit trust management company, right? But I think whether it will affect investment spread, I don't think so, right? It is just more towards the unit trust management company that needs to manage the implication of the e-invoice, right? They will make it as seamless as possible. If there is any additional information that is required, I'm sure they will do it without the investors even notice. Like even they could get it through the account opening form and through interactions with the relationship manager, right? And shouldn't have any adverse implication to the investors.
Well, that's certainly good news for investors. Mr. Fariz, thank you for joining us today on Coffee Talk and providing your views on the various taxes, e-invoicing, and what they mean for investors. Appreciate it. We hope that you have found this session insightful. For more on Coffee Talk, be sure to hit the like and subscribe button on YouTube channel so that you don't miss out on future content. If you do have any topics that you would like to suggest or recommend, please feel free to leave them in the comments section and let us know. See you in the next episode of Coffee Talk.